The single most important decision or action you will take when investing in self-storage is determining which market, which location you're going to buy your property. If you buy a great asset in a bad market, your returns are going to suffer versus what they could if you found an okay asset in a great market, because great markets have higher rents and therefore higher margins, higher profits over the long term as well. So if you can find a facility in a great market with low competition, high rents, it's much better than having a brand shining new facility in a market with, very tough competition and low rents. So it's worth taking the time to understand your market. And you have to accept that at the beginning, you won't know everything, right? You're gonna study a market, you'll have some information. You can't know everything about every market. There's simply too much. 50,000 facilities around the country, all of these different markets. You've got to choose to hone in on an area, get really good at that area, and your knowledge will expand, and the market range that you can, operate in will also expand. Okay, so what does a successful market look like? Which states, which kind of cities should you be looking at? So what you want to be looking at really is the demographics and the population trends, right? If you're starting out buying a multi-story facility in the center of a city, the cap rates are going to be very low because it's a class A asset that all of the REITs are chasing. The competition is very high. It might be very difficult for you to come up with the investment or make any good returns. What we recommend is going after small to mid-sized towns that are stable, have good populations, lower competition, asset prices are much more reasonable, and therefore you can make a better return on your investment as well. So we're going to dive into the different numbers that we need to look for in terms of population and demographics as well. But the other thing to consider is, the demand and supply in that particular market. Is there new development coming online? What's the competition look like? How much rents are they charging, etc. The more information you can gather, the better. Of course, it's a time-consuming process, and you don't want to gather market, information on lots of different markets. So you start with the high-level, quick look, right? You just want to see if a market has a good population, great. If the population's there and the competition looks relatively low and the rents look okay, then you can start to do your deep dive into your competition and the market as well. So it's just a quick check, population, market rents, and the amount, the square footage of the competition in the 3 and 5 mile radius, and we'll cover that in just a second. Okay, so which cities and states? I recommend that you start within a couple of hours drive of where you live. Why? It's your first storage investment. You may need to visit for your facility for whatever reason. It's new to you. And so the more you understand about the market, the better. It's very hard for you to gather information, visit facilities, check out other competition if you're having to fly and stay in a hotel every time, right? Realistically, we would like to be able to do that, but all of us have busy lives. And of course, if you can go there on the weekend and it's near you and you can do your market analysis, you can check out the competition. Are they old units? How full are they? You can talk to the staff. You're going to be able to find a much better deal than if you visit a site once or do everything online remotely. So having something within proximity of you is probably the best. And within a 2-hour radius, there's going to be a facility that's a pretty good deal if you do the legwork. So storage is extremely local also, right? So the state, a particular state, storage might be booming, but storage is based on a very 3 to 5 mile radius typically. And so even though a state's performing well, a city or storage within a city might be doing badly, or vice versa. This state, don't invest in that state, it's terrible. There'll be some fantastic deals buried away in some smaller markets in that state for sure. So it's a very local business. So larger term trends, of course, affect storage, right? Recently we saw with COVID, the statistics were there were more U-Haul trucks going out than there were coming back in, which means that more people were moving out overall. And so what you want to look for is finding these smaller markets and then just look at the general population trends to make sure that it's positive and growing, and that you can't think of anything that's going to change that in the 3 to 10 year period. Of course, none of us can predict the future. We're just looking at what's happening in general, right? If people are generally moving into that city, there's general job creation, that trend is most likely to continue. If you look at the history of man since the beginning of time, and you look at all the major cities, that's tended to happen. If you bought in New York 100 years ago, you would have done very well in your investment just because of the natural flows of people to consolidate in areas that they're already consolidated at. And so I've used a lot of big words there. I'm sorry. I don't even understand half of them. Basically, what you want to do is stick to storage in your local area, somewhere where you can access it reasonably easily, so that you can go and visit 20, 30 facilities over the course of the next couple of months as you look for somewhere to buy, because then your costs are down and you're more likely to follow through and do that as well. Okay, so market demographics. What are we looking for? First thing is that there's enough people, right? If you go to a town, there's one storage facility, and it's 500 units, but there's only 1,000 people in a 10-mile radius, you're in trouble. You'll never fill up that facility. You want to have at least a solid base of people. So what we're looking at is markets where 1 mile from the storage facility you're looking to buy, there's at least 10,000 people. 3 miles from the place you're looking to buy, there's at least 30,000 people, and 5 miles, there's at least 50,000 people. Of course, these are not set in stone rules, they're just guidance. If you find a single facility, but there's 20,000 people in a 10-mile radius and they've got nowhere else to go, the next facility is 40 minutes drive, that facility might be a great investment, and you can check that by looking at the occupancy, looking at the rents that they're charging. If you're the only game in town too, you can increase rents. If you're the only game in town, you can, you're most likely to be fully occupied as well. So these aren't hard and fast numbers, they're just general guidance, but you definitely don't want to be in a market where, there's very, very low populations, because it doesn't matter, how many and the fact that there's no competition, there just isn't enough population to support it. So we want a decent sized population. The second thing is we want that population to be growing, ideally. And there's many, many different tools out there online that you can use to check, demographics for a particular location. There's free tools and there's paid tools. The tool that we like to use is the tool Radius Plus, because it shows a lot of details on the competition, the demographics, everything in one screen, one snapshot. So we can make a very quick decision as to whether a market's good or not. But of course, maybe at the beginning you don't want to pay so much. You can pull up population numbers from a Google search of the town name or the location name, plus demographics or population. So ideally, we want households where the household income is somewhere between $50,000 to $80,000. If it's too low, it might be kind of a low income area. It might be even dangerous to store things there. It might look good on paper, but people go to the area and they don't feel safe because it's a low income area. Maybe there's some crime. I'm not saying every low income area is full of crime. That's not what I'm intending. But what I'm saying is that if the income area is too low, they may not be able to support the rents that you're looking to get. And people may not be comfortable storing their belongings in that part of town. For example, the other thing we look at is maybe the house value. We want at least 300,000. But again, these numbers, they're just general guidance. Like we're not going to pass on a deal because it's 280,000 average house value and everything else looks fantastic. It's just general guidance. These are just some of the additional things. Really, the important thing is you have enough population, that population's growing, low competition, decent rents. These other things are just to give you a feel and an idea. They're not deal killers, they're not deal makers. It's just an understanding of the market that you're operating in. If you had two markets, one with lots of wealthy residents in very expensive houses with high incomes but low storage space, or versus very low income, can't afford the rents, this is what we're trying to choose. We're trying to pitch it right. In very rich neighborhoods, they might have huge amounts of extra rooms where they can store things, or just they don't really care and they're not going to put it into regular storage, right? If their neighborhood's too rich. So we're looking at the kind of middle income, middle class, stable, white collar job areas where they can afford to store and they have belongings and they need to store too. Households are typically 2 or 3 people per household, and the vast majority of the areas that we're buying in, most people don't have basements, right? So you can see that with the tool Radius Plus, and just generally the trend is that there's no basements or attics in a lot of new houses, so that's why people are having to turn to storage and the demand's growing. We do like markets where there's a decent number of renters, at least 20% plus, but the vast majority of storage renters are still people that actually own a house, right? They own a single family residence and they still don't have enough space for their belongings. So it's not hard and fast that you have to have a very high percentage of renters in a market, but renters mean people are moving, people are going in and out, it means that there's going to be a demand for storage there. But much more important than that is that the general trend is that there's a solid population and that population's growing. I mean, if it's declining, that's a really bad sign, and the long term doesn't look good. It's better to avoid that market. Stable, flat is also okay, but ideally you want it to be growing, because more people moving in means they're going to have to find a storage unit to rent stuff, and prices are generally going to tick upwards as well. So the other thing we like to do is a local check of the local economy, right? So town name, Google search, try to find out any recent news on the town, try to find a local publication, get a hold of that, find out who the main employers are they stable, what are the trends in the region. So demographics will only tell you so much, right? Population's 50,000 in the 5-mile radius, population's growing, but what is actually happening? You kind of want to understand, right? If it's the town you live in, you're going to know, these new companies are moving into town, or ooh, my friends all lost their jobs because this warehouse closed down. The more you know about the town, the better decision you can make. So a quick Google search and a quick read around can give you some ideas. And what might even pop up when you're doing a local check is that 3 new facilities are opening in that area in the next year. Because these companies like to announce, we're developing 100,000 square feet in XYZ town. So it gives you some additional information. So you understand the economy, you understand the town, you understand how it is. In addition to just simply knowing the numbers of population, you have a feel for what's going on. And you're trying to see, what's the kind of things happening in this region, what's happening here. Like people moving to Texas is a big overall trend. And then so many cities within that trend are also benefiting from the population growth. So the area that you're considering, what's the bigger picture that's happening, so you can understand beyond simply the recent demographics and the predicted demographics, understand the full picture. So what's super important when you're choosing a facility is the location and the visibility of that facility as well, right? So not only you have the population, if you've got a town with a good population, but your facility's on the edge of town off to one side, only a percentage of the people nearby are going to maybe rent your unit. You obviously want to be closer to the center of the population, and when you're doing your population checks, you want your facility to be the middle, and then you're doing a 1, 3, and 5-mile population check around to understand the real access. The next main thing is the vast majority of your customers are going to be people that have seen your facility. They drive past on their way to work, or they go to the local Walmart. This has been a great one for us. They go to a local Walmart and they see the facility on the way to the Walmart, and then boom, they're renting from you as well. So maybe there is a retail location nearby that attracts customers. You're on the road that takes people to and from there. That's a great location. Or you're on a main highway or main traffic route and you're getting at least 10 or 20,000 vehicles per day going past your location. It's free marketing essentially. You're not paying for ads. People are seeing you, and every time they see you, 1, they're thinking, oh, if I need storage, I can go there. 2, it's another benefit of it is they're also acting as your private police force. You've got 20,000 cars a day going past your facility day and night. It's an extra added layer of security. If people see something, they're most likely going to report it too. So that's just a side benefit. Really what it is we're looking for great visibility from a main freeway or road, because that way, imagine if your facility is back there in the forest and no one knows about it, the only way they're going to find it is if you pay for Google ads or you pay for advertising. That's really, really tough. But if they're seeing it as a natural part of their day, then you're already persuading them, you're already marketing to them without spending any extra cost. So if I had an okay deal but with fantastic visibility in a market with good rents versus an amazing looking property but it's a little bit off and tricky and kind of low occupancy, I would take the high visibility over it, simply because it's so much effort to lease up a unit with low occupancy that you do want to have that added push of being in a visible location. The other thing to consider of the location is the emotional factors, that it looks safe, it feels safe, it's not in a bad location, that the access is easy. So if I'm on the main freeway, but I have to go round here, round there to get to your facility, it may put me off. I might just go up the one where I just drive off and drive straight in. It's easier for me. People are lazy, a couple of twists and turns or extra hassle, they don't want it. So really you want a facility that not only has great visibility, but then has that easy access off that freeway, off the road to get into you, easy drive to get in as well. And the other thing is you know, it's easy to see your facility. There's nothing obscuring it like trees, etc. And that the more road frontage you have, the better, because it's basically a huge free banner essentially for you. Your facility becomes the advert by having this great visibility. Okay, demand and supply. So we've looked at population, we've looked at the location of the facility, we've also looked at, the visibility. We understand the bigger trend. Why are people moving to this town? Why is this population going up? Why do people want to live in this city? What's the local news? We've checked all of that. Now we kind of want to get a picture of the competition. We want an idea. So the national average for storage is 8 square feet per capita is what's being rented. That means the average person is using, 8 square feet each. Okay, and what we saw before in a previous section of this course is that 1 in 10 people are renting a storage unit. So that means basically that each person's using around 80, 100 square foot each. If everyone in the country is using 8 square feet, 1 in 10 are actually renting, so they're actually using about 10 times that, around a 10 by 10 unit on average. Okay, so 8 square feet per capita is the thing. So then when you're doing your check, you have the facility here, and you're looking at the 1, 3, and 5 mile radius, how much storage is available to people there. You may find if you add it all up, there's, a million square feet of storage, but there's 10 million people. So then the amount of storage available to those 10 million people is 1 square foot per 10 people, basically 0.1, very low, right? Low competition. So what we're looking at here really is markets where there is not much square footage total versus the population size. And a tool like Radius Plus will calculate that automatically for you. For example, we've got a market with 250,000 square feet of storage within a 5 mile radius. The population is 50,000, so we're talking about 5 square feet per capita. That's much, much, much lower than the national average. This is good. So really that market could support an extra 150,000 square feet. So 400,000 square feet of storage divided by 50,000 is 8 square feet per capita. So why is this important? It's very simple. If there's 50 square feet of storage per person in a market, so the population is 10,000 and there's about 50 square feet of storage based on all the competition storage added up, then of course there's a lot more competition. The pricing is going to be lower. It's going to be harder to get that customer. If we're in a market where there's 50,000 people, but there's only an average of 2 or 3 square feet per person, that means there's very little supply but very big demand. So we want to be below that number as far as possible. Being at 8 square feet, the average is perfectly fine, because we're also going to be looking at a couple of other factors like the rents. But in general, what we want is, of course, the less supply there is in the market, the better it is for us. But later our checks of the competition, like the occupancy, the prices they're charging, will make that a lot clearer. So this is just a guidance. So again, with the population, we're doing a quick check. Are the numbers there? Is it growing? Yes. Next, okay, so what's the competition? 8 square feet per capita. Okay, so if we're in a market where it's 16, that's kind of a warning sign, right? We may not want to look into that market so much as a market where we found that the square foot per capita is 5 square feet per capita. Okay, next, if we find a market where there's relatively good square footage per capita, in the sense that there's not much storage available, next we want to understand the quality of that storage. The best would be to visit those facilities, to do some sort of on-the-ground feasibility study. You want to see, do they look good? Do they look old? Do they have cameras? Do they have gating? All of these general things, the same way a storage customer might look at it. If there's 10 facilities in the town you're considering, 8 of them really old, 7 of them didn't even pick up the phone when you tried to call them, but there's one facility that you're considering buying that looks a little better, or with some improvements will look better, then maybe that's an opportunity. The other thing we're checking when we're calling them is their customer service. Are they responsive? Are they good at customer service? I found so many facilities don't even pick up the phone. It's crazy, right? So they've done all of this work, they've bought this facility, they own it, and they don't even answer the phone when a customer wants to rent a unit from them. The other great thing to ask when you are calling competition is to find out the rental rates for a couple of the standard sizes. So like a 10 by 10, 10 by 20, with air conditioning, without air conditioning. And you can also on your call, when you're finding out saying, I'm looking to move into this area, I'm going to need to put my stuff there for a few months because my job, I have to move here. you know, how much is it going to be? The other thing you can find out at the same time is how full are they? You know, like, okay, so can I move in like a couple of weeks? Are you guys pretty full? How many units do you have available? Because there's 3 of us moving for work to this town from my company. And they can say, sorry, we only have 1 unit available. Oh, don't worry, we have plenty of units available. It's a little bit sneaky, but it's essential to get an understanding of your competition, their occupancy, how full they are, their pricing, everything. And what you also want to do is check their website, because sometimes the website gives away the pricing and whether units are full. If it's crossed off on the website, you can see, okay, all the 10 by 10s are gone. So they're full already. And when you call, you can verify that information too. So your competition check is twofold. One is just a general, how much square footage is there of competition in the area, what new developments are coming online. The second is, what's the quality of that competition versus the facility I'm looking to buy, and what rents could I potentially charge. And what we found many times is there may be a facility where they haven't raised rents for a few years. The competition are all charging, you know, $150 for a 10 by 10 unit, and this facility is still charging $90 for the same size. Yes, it might be a little older, but we can bump those rents to 130, increase the profits, increase the value of the facility. So really what you're looking at is you're comparing the investment you're considering versus the competition, trying to suss out, is there room for increases, what's the market look like, how full are they, etc. Rents. So the easiest way to make money in storage is to buy an existing facility with very high expenses, very low income, when in a market where you can support much higher income. So for example, as I said just now, maybe someone's got the rents at 90 per square foot, 90 per unit for a 10 by 10, but the market is all charging 150, even much older properties. Simply by increasing the rents, you've got a big growth in revenue. After expenses, you've got a big growth in profits as well. So it's a very simple way to make money in the market. The other thing is, if you're buying a facility, it doesn't matter if it's not under market rents. It can be at market rents if there's no upside, because there may be other ways to add value. You might be able to expand the facility. You maybe add to cosmetic improvements, add some security cameras, lighting and gating, and then increase the rents. There's different ways to add value to a facility, and we'll cover that in another section of the course. The important thing is, if I said to you, would you rather be in a market where you get $5 per square foot for your storage space as an owner, or $15 per square foot for your storage space as an owner? If the price of the properties was both the same, you would choose the one with higher rents. But sometimes it's worth paying a lot more for something with higher rents, because your base costs, your base fixed cost of operating a facility are fixed, right? If you have your utilities, your overhead, everything. If you're on a market with low rents and low revenue, those costs are going to eat up a larger percentage. If you're paying more for a facility, but you're having much higher revenues, those fixed costs make up a much smaller percentage of those same revenues. So it's like, imagine my cost to run my facility every year is 100,000. In one market, my income is 200,000. I paid 100,000. I've got 100,000 left. In another market, my income is 500,000. I paid 100,000. I've got 400,000 left. Obviously, I would pay more for the one with higher income, and higher income means higher rents. So it tends to be more better profit margins for markets with higher rents, but also then in the future, if you expand your unit, etc., you're going to get higher returns on investment for it as well. And there are different ways to actually increase the rents. One, it could be simply under market. Two, what if you paint some additional units? Maybe some units are broken and you fix them. Maybe you put up a better sign. Maybe you're better at marketing your property than your competition. So now you've got a traffic coming to you from your website, from your ads, and then you can increase market rents because you've got a backlog of customers. You can test higher prices that way. It doesn't mean that your rents are fixed. You have to do things to then grow those rents. But what you do want to do is find markets where overall the rents are a good number, because then you've got a great starting point. Like, we tend to look for $10–12 per square foot minimum for the markets that we want to buy in. If it's below that, then expenses make up too much of a percentage of revenue. It's very hard to make it profitable at $6 per square foot rented, no matter how cheap you buy the property, because the expenses are kind of fixed. But on the upside, on these higher rent markets, is that, there is much more room to be creative. It's very hard to be creative if you're only going to get $5 a square foot. But if you can do something to boost your revenues and rents from $12 a square foot to $16 a square foot, because that's what the market supports, then you can make a lot more money and return as a result of that also. The other thing we look at when choosing our locations is barriers to entry, the market, right? If there's land everywhere, if you go online and there's land everywhere for sale, self-storage land available, lots of land available, nothing to stop anyone moving in. Yes, you may have a great market now. What if someone builds a facility next year, next door to you? It could destroy your market. So we do like markets where it's very hard for competition to put in additional storage space, where there's restrictions with zoning, where it's very hard to get, there is very little land available for sale. There may be a parcel within a larger kind of city built up area, and then that becomes a fantastic investment because the barriers to entry is there's simply no other land available. The other great way we make use of that is conversions. So we may buy an old retail center and convert it into storage because there's no other land available for sale, and there's no other properties that can then be converted. So we're getting into a market where there's barriers to entry. Some markets are great on paper, but then, you know, competitor moves in, could be a mom and pop business, maybe they don't care, keep dropping rents, and there's nothing you can do except for fight them, and you're basically fighting tooth and nail for the same customers. So that's why all of these factors are important when considering your where you're going, is high rents, good population, low competition, and then also that you don't want more competition in the future. That's what the barriers to entry part is you're thinking about the next 5-10 years. Can someone else come in here and eat my meal off my plate because they're building a bigger facility, or they can easily expand and then basically increase the supply too much in the area. As we said before, we want to look at the trends of the area too. So is the population growing or decreasing? What's happened with the storage rents in the area over the last 1 year, 3 years, 5 years? Where are they heading at the moment? Have they been increasing recently? Have they been decreasing? Tools like Radius Plus can show you this, but also, you know, your market research, speaking to facilities, can also show you more information too. So you're really asking, and this is a kind of a quote from Mark Cuban, if I wanted to kick my own ass, what could I do in this market to kick my own ass? That's how he approaches business. So really what you're thinking is, if I bought a self-storage facility here, if I bought this particular property, what could affect me? You know, and you're trying to cover off those downsides. Honestly, if everything looks good, good market, low competition, good rents, usually there's a lot of factors working towards that being the case, and you're not going to find, you know, a red flag that's going to kill the deal. But you should always think through the process and check, because then that way at least you know up front, you know, okay, this market looks like anyone can build. The zoning's very open, so it might look great now, but I would rather place my dollars in a market where zoning is very difficult, but I found a facility that has it already. Boom, that's a better investment for the long term. So the summary, looking at ideally 30 to 50,000 people within a 3 to 5 mile radius of the facility. Traffic counts 10,000 plus is fine, vehicles going past, but ideally we do want 20-25,000 plus because it helps. You want a decent medium family household income. You really want to be buying a larger facility, so 400 to 500 units, 50,000 square feet plus. If you've got 5,000 square feet, your costs, your expenses are fixed, you've got management costs, everything, you don't have enough revenue to cover those. Ideally, you want markets where there's already high rents and low vacancy. In general, your facility you're buying doesn't have to have those, because you can make operational improvements to get to there. The other thing you want is the high barriers to entry. Ideally, we want to be under the 8 square feet per person nationally. A lot of markets we buy in have 5 or 6 square feet of storage per capita, which means that generally they're undersupplied, and rental rates around $1 per square foot per month, which equates to $12 per year per square foot. And how do you calculate that? Is the total rents divided by the square footage over the course of the year for the property will give you that number, and we can cover that in more detail in another section of this course as well.
For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening.